We're seeing the outperformance there and a record high for the Russell 2002, Romain.
Yeah, small caps are definitely doing their part. Part of that small cap rally involves the banks. You're actually seeing the KBW Bank Index, which of course includes a lot of the big bank indexes that have been higher in the day, actually moving a little bit lower here as we move towards the close. Of course, being batted around, of course, by the rate environment. We've been talking a lot about Bitcoin. You see the main vehicle for a lot of folks here, GBTC, the Great Scale Bitcoin Trust up 8% here on the day. The ITB also rallying, of course, up 4% here on the day. Lennar seems to be the catalyst there. And keep an eye on the transports because that's been kind of a sneaky move higher here. You're seeing UPS higher, FedEx. Remember, their shares up 1%. Those earnings expected after the bell. Double-digit revenue growth expectation on tap. We'll see once we get the closing bell at 4 p.m.
All right, Romain, well, let's get some more market analysis now. We're joined by Stephen Whiting. He is Global Chief Investment Strategist and Chief Economist at Citi Private Bank. Stephen, I'm looking at markets ready to close at record highs. On the same day, we got a disappointing print on initial jobless claims, 885,000. Just yesterday, a disappointing print on retail sales. Why, in your opinion, is the market so willing to look past weakness near term in the data?
Well, one part of it is the increasing likelihood that we'll see additional bridging stimulus for the U.S. economy, a number along the lines of $700 billion to $1 trillion ought to be a sufficient bridge. It won't make everyone whole, it won't solve every business's problem, and it won't stop every state or local job cut. But that, along with, at this stage, of our preparedness for this COVID emergency, and the fact that vaccines are ahead by mid-year, would certainly be sufficient to get us through this period of weakness. And so equity markets are very forward-looking. I'd expect a very strong year, particularly back half of 2021, as you heard from Jerome Powell, and a very strong 2022. So the returns we're having now are in anticipation of that.
What as and when we get there? I mean, can we continue to reach new highs? Can we continue to foresee economic growth, profitability improving out to 2022, 2023? At what point do we catch our breath and think about the valuations and the record highs that we're at?
Well, let's think about this from two perspectives. We have about 4 million people in the United States who aren't participating in the labor force specifically because of COVID. We had an unemployment rate that says 6.7%. Well, if you augment for those people who are sidelines, the unemployment rate's about 10% in the United States. Now, that's down from 20, but it means we have the capacity in a new economic cycle to grow at an above-trend pace for a couple of years at minimum. Things are moving very fast here. This was an external shock to the economy. We perhaps didn't wipe off every particular problem, but you combine that with the other factor, and that is financial repression. That the Federal Reserve is not going to let government debt burdens prevent us from having a post-COVID economic recovery. That we're going to have negative real interest rates for a long period of time. Yeah. And the last time the U.S. government's debt burden was 100% of GDP, the size of the treasury stock compared to the size of the economy, it was 1945. Well, we ended up with lower negative rates all the way to the 1970s. So we can have a very long period here of unattractive fixed income returns. Now, I think that the particular equity assets that are rebounding now, things that we position for, like small cap stocks in Latin America, some of these are just bounce backs. But there are other drivers of long-term growth. And some of those are more highly valued, but they're not highly valued compared to the bond market, which is particularly rich.
Yeah, some of this is a bounce back. I mean, I want to go back to timing. I mean, you touched a little bit on the idea of where we are in the market cycle, and I guess how you view this market is going to be kind of dependent on how you view whether we're sort of at the beginning of the cycle, in the middle of the cycle, or at the end. What gives you confidence right now that the current cycle we're in right now is more towards the early stages rather than just sort of the fumes from the last cycle?
Well, it's the economy itself. And I think about this year, 2020 and 2021 are both distorted years from an exogenous shock. We came into 2020 without any particular overextended industries. There were no booms going on. Supply and demand in the U.S. or the world economy were not out of line. Inflation was low as a starting point. And savings rates. There were no real excesses there on consumption. So even if it was a 10-year-old expansion as COVID hit at the time and it ended it, we were in a position to grow. for the next couple of years. This, again, is quite artificial to all of that. We have taken some really, really extraordinary steps in terms of fiscal and monetary policy. They're costly steps, but they will limit the long-term damage. And then when we think about our starting point for this, we've gotten back half of the jobs that were lost because of this COVID collapse. There's considerable fuel, even if we slow down, for a prolonged period of economic growth.
All right.
So I would say that, plus asset markets that are not priced like they were a decade ago for a deeply depressed, high return environment when nobody wants to invest. Sure, we've got exuberance up a little bit, but many of these industries, the kind of dispersion we've seen, there are sectors that are down 20% this year just because of COVID. So I think there's a good opportunity here still for investors.
All right, Stephen, you're sticking with us. Stephen Whiting, of course, Global Chief Investment Strategist and Chief Economist over at Citi Private Bank, helping us count down to the close. About 4 minutes to go. We want to jump over to the big board. Katie Greifeld, what are you watching?
Well, it is just green across the board. All the major indexes are pointing higher towards the close, and it's new record highs, like you said, for the S&P 500, for the NASDAQ. But we'll just note that it's the little guys leading the way. The Russell 2000 index poised to close about 1% higher, and that's even though Congress is no closer to passing a fiscal aid bill with the end of the year in sight. But it's still the vaccine rollout, and a dovish Jerome Powell yesterday just helped boost risk appetite today and just fuel that cyclical rally. And speaking of the Fed, I want to point to break-evens. They continue to rise today, those inflation expectations, with 5-year break-evens touching their highest level since 2019. And Bank of America's Mark Cabana made the point on Bloomberg Television earlier that this is what the Fed wants to see. They want to see those inflation expectations rising as they try to overshoot that 2% inflation target that they failed to consistently hit for years. And meanwhile, Bitcoin had another big day. It briefly broke above $23,000 a coin. It's paired a little bit, but that brings me to our stock of the hour, which is Marathon Patent. It's one of the few publicly traded crypto miners, and it just surged today, up about 14-15% today, as investors try to get their hands on anything crypto related in the equity markets. Kelly.
All right, Katie, thank you. Still with us is Steve Whiting of Citi Private Bank. And Steve, I gotta ask you, Bitcoin, what are your thoughts?
Well, the investments that we consider really worthy of core portfolio investments are income-producing assets, or they're assets that can be sold, that are tangible. There can be intangible assets that can create incomes. So things that create goods and services that are consumed in the economy. So we're talking about corporate equities, we're talking about loans and bonds. What is Bitcoin? Well, perhaps there are some utilities out there in the future, but it's a secret code that you can sell to somebody else so they can have a secret code to sell to someone else. And until there are a lot of utilities for that, you have something that is really worth what the next guy's willing to pay, and that attracts a lot more buyers when the price is going up. So that's a very bubble-like dynamic. And I think in terms of the ability to have a limited finite supply and the ability to have the creation of new secret codes, in other words, other cryptocurrencies, that can also, again, it can get very big. I mean, the market for cryptocurrencies is pretty small relative to the market cap of any large asset class, but there really is nothing inside of Bitcoin that really is a claim on real assets. So for us, that's not a core investment.
All right, we're speaking here with Stephen Whiting, Global Chief Investment Strategist and Chief Economist at Citi Private Bank, helping us count you down to the close, setting up here for the closing bells in New York. You're going to take a look pretty soon here at a Dow Jones Industrial Average trading at a record high, an S&P 500 trading at a record high, and a NASDAQ Composite looking like it's going to close also at a record high. Kaylee, this is a day, and frankly, this week that I think a lot of folks, if you had gone back a year ago and asked them how 2020 would end, I don't think this is how you would have predicted.
Yeah, I think the average strategist target 12 months ago was something like 3280. We're setting up here to close at 3722 remain. I mean, no one saw this rally coming. I think also if you went back 12 years ago, people would probably, or 12 months ago, excuse me, probably told you yields were going to be higher on the year. We know that did not happen. The 10-year yield remains below 1% at this point, Romain.
Yeah, and we talk about, some of the other indices that have moved. I mean, we saw the transports really get a bit, a lot of the materials, the utilities as well. So this isn't really just a tech rally. You had pretty strong market breadth here, about 90% of the NYSE composite above that 200-day moving average. This is the first time, believe it or not, that's actually happened since 2009, according to the data out there. And so you're talking about a certain euphoria here and a certain confidence, I guess, if you will, not only in the economic recovery, but in the idea here, Kaylee, that at current valuations, this market might have a lot more room to go.
Yeah, it's a fair point, Romain, but if you were going to tell me that it was confidence in an economic recovery that we were looking at in the market, I might expect yields to be a little bit higher, but nonetheless, the 10-year yield remains down around 93 basis points. It climbed just a basis point today. A little bit more movement on the farther end of the curve. The 30-year yield, up about 2 basis points, but you still have the Fed as that anchor. Maybe they didn't extend maturities yesterday, but they still could, and that means yields are staying relatively low based on historic relativity.
Let's bring Stephen Whiting back into this conversation, Global Chief Investment Strategist and Chief Economist over at Citi Private Bank. I mean, Stephen, obviously markets don't go in a straight line. There's going to be pullbacks along the way.
Thank you.